Every time you swipe your credit card, pay your mortgage, take a personal loan, or even collect interest on your savings, you're participating in a system that began over 4,000 years ago, long before modern banks, before paper money, before nations even existed. The truth is, interest and lending didn't just shape economies, they shaped civilizations. Empires rose on credit, wars were fought because of debt, entire societies collapsed because they could no longer pay what they owed. And today, the same powerful forces still influence your life quietly, constantly, and in ways most people never notice. Now, you'll explore one of the most important and least understood stories in human history, how lending began, how it evolved, and how it became the backbone of modern finance. You'll see how Mesopotamian farmers borrowing barley led to the creation of the first financial records, how Greek philosophers debated whether interest was morally wrong, how Roman bankers invented legal credit systems, and how medieval religious restrictions shaped European lending for centuries. You'll learn how powerful banking families like the Medici built global financial networks, how interest fueled the age of exploration, and how the Industrial Revolution transformed lending from a merchant activity into the engine of modern capitalism. And finally, we'll explore how digital banking, fintech, and crypto are creating the next evolution of lending, one that could reshape the world again. Because once you understand the patterns behind interest and lending, you'll start seeing the world differently. From your student loans to national debt, from credit cards to crypto lending, it all connects back to an ancient story humanity still hasn't stopped writing. To understand where lending truly began, we travel back over 4,000 years to ancient Mesopotamia, the land between the Tigris and Euphrates rivers, often called the cradle of civilization. Here, something revolutionary happened. Humans began recording financial transactions. Before coins, before cash, before banks, the temples of Mesopotamia became the earliest financial institutions in history. These temples acted as vaults, storage centers, and eventually places where people could borrow goods, especially grain and silver. Farmers would approach temple officials for barley, which they needed for planting or survival during difficult seasons. In return, they agreed to pay back more than they borrowed, the earliest known form of interest. Clay tablets written in cuneiform detail exact loan terms. If you borrow 1 gur of barley, you must repay 1 1/3. That's a 33% interest rate, a number shockingly similar to modern credit card rates. Silver loans typically carried around 20% interest, showing that the concept of risk-based pricing existed even then. Why did interest appear? Because crops failed. People needed resources, and lenders, not whether temples or wealthy merchants, demanded compensation for the risk of not being repaid. These early loans did more than help farmers survive. They helped Mesopotamia grow into the world's first complex economy. Trade expanded, merchant classes emerged, debt laws developed. Even the famous Code of Hammurabi included detailed regulations on lending, interest, collateral, debt slavery, and loan forgiveness. Debt could also become dangerous. Families lost land, freedom, or even their children if they couldn't repay loans. At times, rulers had to cancel all debts to prevent social collapse, an early version of economic reset. Mesopotamia didn't just invent writing, it invented finance. While Mesopotamia laid the foundation for formal lending, 3 other great civilizations developed their own credit systems, each shaped by culture, religion, and the needs of their economies. These parallel evolutions show that lending wasn't an accident. It was a universal human invention. In China, lending dates back to the Zhou dynasty around 1000 BC. Wealthy landowners often lent grain to farmers, especially during famines. Unlike Mesopotamia, China quickly introduced government involvement. The state imposed interest rate caps, usually around 20%, to protect peasants from excessive debt. But despite regulation, private lending flourished. By the Han Dynasty, China developed sophisticated lending networks, pawnshops, and contracts, clear signs of a structured financial system. India's lending traditions go back even further, mentioned in the Vedic texts. Interest was called kusita, and it sparked deep moral and philosophical debates. While lending was widely practiced, excessive interest, usury, was condemned. The Manusmriti, an ancient legal text, specifically detailed acceptable rates depending on caste and profession. Merchants could charge higher rates due to risk. Brahmins were encouraged to charge little or no interest. Ancient India's traders also pioneered maritime loans, financing sea voyages to Southeast Asia and the Middle East. Egypt developed a lending system centered around grain storage. Massive state-run granaries acted as protobanks. Farmers deposited grain and received warehouse receipts, which could be traded or used as proof of repayment. Loans in Egypt often involved grain for survival, especially during low Nile flood years. Egyptian loan contracts, written on papyrus, show interest was normally paid in extra grain or labor. Across these civilizations, one pattern emerges. Lending rose wherever people faced uncertainty: crops, trade, weather, or survival. Interest became the price of risk, and debt became a permanent part of human life. Classical Greece is often celebrated for its philosophy, democracy, and arts, but it also played a major role in the evolution of lending. Unlike Mesopotamia and Egypt, where lending emerged from temples and agriculture, Greece developed lending through trade, especially maritime commerce. Greek merchants traveled across the Mediterranean, financing voyages that carried olive oil, wine, metals, pottery, and slaves. These journeys were dangerous: storms, pirates, shipwrecks, so lenders charged very high interest rates to compensate for risk. Maritime loans could reach 30 to 60%, sometimes even higher, if the season was risky. But while merchants embraced lending as a practical tool for wealth creation, Greek philosophers saw it differently. Aristotle famously condemned interest, arguing that money was sterile and should not breed more money. He believed lending violated nature because it generated profit without labor or production. Plato expressed similar concerns, warning that lending could destabilize society by empowering the wealthy and trapping the poor in cycles of debt. Despite philosophical objections, Greece depended heavily on credit. In Athens, lending became so common that contracts specified collateral, repayment deadlines, and penalties. Slavery was often used as collateral, a brutal reminder that debt could destroy lives. Meanwhile, wealthy citizens used lending to build influence and political power. Greece's legal structure also advanced lending. Courts enforced loan agreements strictly. Foreign traders were protected through special laws. And in Piraeus, Athens' major port, bankers called trapezitai handled deposits, money changing, and loans, early prototypes of modern commercial bankers. Ultimately, Greece gave the world two legacies: the intellectual debate over whether interest is moral or exploitative, a practical financial system, especially maritime lending, that fueled Mediterranean trade. The tension between moral criticism and economic necessity continues even today, from payday loans to credit cards to student debt. If Mesopotamia invented lending and Greece expanded its commercial use, ancient Rome professionalized it. Rome built one of the first fully regulated banking systems in world history, creating laws, institutions, and financial roles that still influence modern banking today. At the heart of Roman finance were the Argentari, highly skilled moneylenders, deposit takers, and contract managers. These weren't temple priests or traveling merchants. They were full-time financial professionals operating shops in busy marketplaces. They exchanged currencies, offered loans, stored valuables, facilitated payments, and even mediated business deals. In many ways, a Roman Argentarius functioned like a modern banker. Rome took lending seriously. The government created strict regulations on interest rates. During the Republic period, interest was capped at 8.33% per year, known as the unciarium finis. At times, the state even outlawed interest entirely, though enforcement was inconsistent. Despite these attempts, lending continued to flourish, especially among the wealthy elite. Debt became both the engine and the enemy of Roman society. Citizens borrowed to buy land, slaves, businesses, and political office. But when harvests failed or wars disrupted the economy, borrowers couldn't repay. This led to repeated debt crises, where angry peasants protested against their wealthy creditors. Some revolts nearly toppled the Republic. The Roman historian Livy described debt as a constant source of political turmoil. Julius Caesar implemented major debt reforms to stabilize the state. He froze interest, reduced outstanding debts, and restored order to the financial system. Later, emperors continued creating banking regulations, making Rome's credit markets more predictable. Rome also innovated legal contracts, collateral rules, and bankruptcy procedures, many of which became foundations for European financial law after the empire fell. When Rome collapsed, its complex financial system collapsed with it, plunging Europe into centuries of economic simplicity and moral debates over lending. After the fall of Rome, Europe entered a period where lending became morally complicated, legally restricted, and socially stigmatized. The Middle Ages were dominated by religious doctrine, and both Christianity and Islam took strong positions against charging interest, which they called usury. This wasn't just a spiritual belief, it shaped the entire economic structure of medieval society. The Catholic Church condemned interest as sinful because it allowed someone to profit from time, something considered a gift from God. Church councils repeatedly banned usury, and priests refused sacraments to known moneylenders. As a result, Christian merchants avoided openly charging interest, pushing lending into the shadows. However, trade needed credit. So Europeans created creative workarounds, such as disguised interest as service fees, partnership loans, where repayment depended on business success, bills of exchange, allowing hidden interest through currency differences. These financial inventions laid the groundwork for modern banking. Islamic law forbade riba, or exploitative interest, but allowed profit-sharing arrangements. The Islamic world developed sophisticated financial tools: mudaraba, profit-sharing partnership; musharaka, joint investments; sukuk, early forms of bonds. Islamic finance flourished because it aligned with powerful trade networks across the Middle East, Africa, and Asia. Because Christians were forbidden from charging interest to other Christians, Jewish communities became Europe's primary lenders. They were legally allowed to lend at interest and filled the economic gap left by Christian restrictions. But this brought resentment and persecution. Despite hardship, Jewish lenders played a crucial role in Europe's early financial development. In the Middle Ages, moral rules suppressed lending on the surface, but economic necessity forced innovation underneath. Europe's later financial revolution would rise directly from these contradictions. The Renaissance marked the moment when Europe rediscovered finance, transforming lending from a restricted, morally debated activity into a powerful engine of commerce and political influence. At the center of this revolution were the great Italian banking families, especially in Florence, Venice, and Genoa. These families didn't just lend money, they reshaped the structure of Western finance. The Medici family of Florence built the most influential financial empire of the 15th century. Their innovations included double-entry bookkeeping, which allowed accurate tracking of loans and credits, the foundation of modern accounting, bills of exchange, enabling long-distance trade without transporting gold, branch banking with Medici offices in Rome, London, Bruges, and beyond. By mastering these tools, the Medicis were able to finance kings, popes, and merchants. Their political power grew alongside their financial influence, proving that money and government had become inseparable. Before the Medici, Florence's Bardi and Peruzzi families financed entire kingdoms. They lent massive sums to European monarchs, including England's King Edward III. When Edward defaulted in 1345, both banks collapsed, triggering one of Europe's first international financial crises. This revealed a dangerous truth. Lending to governments carried enormous risk, a lesson still relevant today. The port cities of Venice and Genoa developed advanced public finance systems. They issued state-backed bonds, funded naval expansion through public debt, and created early versions of government treasuries. Venetian merchants used credit networks that stretched across the Mediterranean, connecting Europe to Asia. The Renaissance transformed lending into a profession, a science, and a political force. Banking families became the power behind thrones, proving that money could shape history as much as armies or kings. The 16th to 18th centuries marked a financial turning point unlike any other. As European powers began exploring and conquering the world, credit and lending became the fuel of global expansion. Empires did not grow because kings were wealthy. They grew because bankers financed their ambitions. This era fused exploration, trade, and lending into a single global economic machine. The creation of joint stock companies such as the Dutch East India Company, VOC, and the British East India Company revolutionized lending. Instead of relying on one wealthy patron, merchants could now raise capital from hundreds of investors. These investors received shares and expected returns, interest-like profits, from overseas trade. This was the birth of corporate finance. The VOC even issued tradable shares and bonds, becoming the prototype of the modern stock market. Investors lent money to finance ships, soldiers, spices, colonies, and trade networks stretching from Africa to Asia. As global trade intensified, governments realized they needed stable financial systems. The most important innovation was the creation of central banks. The Bank of England, 1694, was founded specifically to lend money to the government to fund war against France. Investors received guaranteed interest backed by taxes. This made public debt a permanent feature of national economies. Loans financed colonial expeditions, naval fleets, and wars. European nations borrowed heavily to maintain their empires. Interest payments became a hidden cost of global domination. Without lenders, there would have been no spice trade, no colonies, and no European naval supremacy. For the first time, interest rates in Amsterdam could influence trade in India or Africa. Money and credit became truly international. The Industrial Revolution, beginning in the late 1700s, was one of the greatest economic transformations in human history, and none of it would have been possible without credit. Factories, railways, steel mills, and mass production all required enormous upfront investment. Ordinary merchants and craftsmen could no longer fund growth on their own. They needed banks, investors, and lenders. This era turned lending from a tool of merchants and monarchs into the central engine of capitalism. Banks expanded rapidly to meet industrial demand. They pooled the savings of thousands of people and lent massive sums to entrepreneurs. This made it possible to build railroads that stretched across continents, construct giant factories, invest in new technologies like steam engines, mass-produce goods at levels previously unimaginable. Lending wasn't just about survival anymore. It became the fuel for innovation. To support large-scale industrial lending, banks introduced more formal standardized interest rates. Risk assessment became more scientific. Instead of personal relationships determining a loan, bankers analyzed business models, collateral, and projected profits. The modern concept of creditworthiness was born. For the first time, ordinary workers gained access to savings accounts, personal loans, and mortgages. This democratization of finance expanded the middle class and allowed people to buy homes, start businesses, and participate in the formal economy. Credit became part of everyday life. Easy access to credit also triggered the first global financial crises. Overbuilding, speculation, and excessive borrowing caused repeated collapses, such as the railway bubbles in Britain and America. The Industrial Revolution revealed a powerful truth. Credit creates growth, but too much credit creates disaster. The 20th century transformed lending more dramatically than any previous era. For the first time, governments, banks, and ordinary citizens became deeply interconnected through a complex financial system. This began with the creation of the Federal Reserve in 1913, which fundamentally reshaped how interest worked. The Fed was designed to stabilize the economy, control inflation, and act as a lender of last resort during crises. This meant interest rates, once controlled mostly by private bankers, were now tools of national economic policy. The ability to raise or lower rates gave governments unprecedented power over growth and recession. The Great Depression of the 1930s became a turning point. When banks collapsed and millions lost their savings, trust in the financial system shattered. In response, governments introduced strong regulations, deposit insurance, and lending standards. Loans became safer, but they also became more tightly supervised. As economies recovered after World War II, lending exploded. Mortgages allowed millions of families to buy homes. Auto loans put cars in driveways. Business credit funded the rise of corporations. Lending became a pathway to middle-class life. By the 1950s and 60s, a new invention changed everything: the credit card. For the first time, consumers could borrow instantly with a swipe instead of filling out paperwork at a bank. Banks quickly realized that small, everyday lending could be even more profitable than big industrial loans. Interest on unpaid balances became a major source of revenue, and consumer debt grew rapidly. The late 20th century introduced even more complex systems: mortgage-backed securities, corporate bonds, student loans, and global capital markets. Deregulation in the 1980s and 90s unleashed a wave of financial innovation, but also set the stage for future crises. By the end of the century, lending wasn't just a service, it had become the backbone of the global economy. The 21st century ushered in the most rapid and disruptive transformation in the history of lending. For thousands of years, borrowing required human intermediaries: priests, merchants, bankers, or government officials. But in the digital age, technology took center stage. Lending no longer depended on face-to-face relationships. It shifted into algorithms, apps, online platforms, and decentralized systems that operate across borders in seconds. Traditional banks were no longer the only lenders. Fintech companies emerged with powerful software that could approve loans instantly based on digital behavior, spending patterns, or mobile data. Peer-to-peer lending platforms allowed ordinary people to lend directly to others, bypassing banks entirely. Microloan services reached millions in developing countries, giving small entrepreneurs the ability to grow businesses with only a mobile phone. These innovations expanded access to credit, creating new opportunities for individuals who were once excluded from financial systems. At the same time, a new and often unregulated world of shadow banking expanded behind the scenes. These were financial institutions that behaved like banks, lending money, creating credit, and managing risk, without being supervised like traditional banks. Hedge funds, private lenders, and financial technology firms fueled a massive boom in corporate and consumer borrowing. The global financial crisis of 2008 revealed the dangers of this system when mortgage-backed securities collapsed, showing how interconnected and fragile modern lending had become. As technology advanced, cryptocurrency and blockchain introduced an entirely new frontier. Decentralized finance, or DeFi, allowed people to borrow and lend without banks, using smart contracts instead of human oversight. Crypto lending platforms offered high yields but also carried extreme risk, as seen in multiple collapses during the early 2020s. Meanwhile, AI-driven credit scoring created both efficiency and ethical debates about data privacy. In the 21st century, lending became borderless, instant, and deeply digital, reshaping economies faster than any previous era in history. As we reach the end of this journey through the history of interest and lending, one truth becomes clear. Credit has always been more than just money. It is a reflection of human ambition, uncertainty, creativity, and survival. From Mesopotamian farmers carving loan terms into clay tablets to artificial intelligence approving digital loans in milliseconds, the systems we use may change, but the motivations behind them remain the same. People borrow because they hope for a better future. Lenders charge interest because risk must be priced, and societies rise or fall depending on how well they balance these forces. Understanding this long story helps us see the modern world with new clarity. The debt cycles that toppled ancient kingdoms still affect nations today. The moral debates that troubled Greek philosophers echo in today's discussions about student loans, payday lending, and economic inequality. The banking families of the Renaissance pioneered tools that shape global finance even now. The same dynamics that powered the Industrial Revolution fuel today's tech giants, startups, and global credit markets. And the digital innovations of the 21st century, mobile lending, crypto, DeFi, are simply the newest chapters in an ancient narrative. So the next time you see an interest rate change, sign a loan agreement, hear news about national debt, or use a credit card, remember that you're participating in a story thousands of years old. A story that built cities, funded wars, triggered revolutions, and pushed humanity forward. A story that continues to evolve with every technological breakthrough and every economic cycle. If you want to explore more deep histories, financial secrets, or the hidden forces shaping our world today, make sure to like this video, subscribe to the channel, and turn on notifications. And don't forget to share your thoughts in the comments. History isn't just the past. It makes the blueprint for the future we're all creating together.